Thank you, everyone, for joining Saratoga Group's Quarter 1 Fund 4 overview call today. My name is Josh Delport, and I'm the Regional Manager for Saratoga Group. On the call today, we have Becky Smallwood, who is our COO, Sam Hales, who is our CEO, and I did that backwards. Yeah, so I just did exactly what Fletcher did. I apologize. Sam Hales, our CEO, Fletcher Alexander, our project manager, and Luke Hales, our COO. At this time, I'm going to turn it over to Sam so he can go over some of the Q1 results.
Fantastic. Thank you, Josh, and we appreciate everybody joining us today. This webinar is being recorded, so if you know of others that would like to view it, we will have it. We'll send out a link to it shortly after we've concluded. I guess Josh kind of introduced us already. I've been in the full-time in the real estate business, fund management for about 10 years, and we've done a number of different things at Saratoga Group. We've done a lot of single-family home investment, ran a pretty large fund there, and we've also done some infill development, multifamily development, office investment. But anyway, we're all in on the mobile home communities, and we're definitely glad to be in this space. I think at this time particularly. And so anyway, I'm gonna share our Q1 results. I mentioned this in the write-up that we sent out, which is you're going to see kind of some huge disparities between maybe what we project. You know, if we look at our chart here, projected revenue at Los Robles versus the actual revenues being much higher. And the reason for that is a lot of times when we take over a community, if there's a lot of park-owned homes, we don't include non-recurring revenue in our projections. And so they're still going to happen, right? We still monetize when we sell a home, let's say that we bought with a community, but that's not a recurring revenue. So it's just kind of a one-time revenue that we book as we sell those homes. So we're going to see this quite a bit where with communities we purchase where there are a lot of park-owned homes, you're going to see a couple quarters where we kind of have revenue that's showing up there initially that is going to disappear. Of course, part of that is a lot of times in those communities, what they've done is the current owner or the seller typically has a low amount of the total rent allocated to the lot rent, and they have a much larger portion to the home rent. And so what we do is this gives us a chance to kind of reset the rents. You know, we even without changing the total payment, we can, let's say the total payment for a home was $550, and they had $150 towards a lot and $400 to the home. Then, you know, in a place like Los Robles, we're resetting that. That's $300 for the lot rent, and then it's going to be like $250 for the home as they buy it or pay it off. So anyway, we're definitely on track with in terms of the revenue as well as the net income that we're seeing so far. We're obviously pretty early in the fund here, and initially aren't projecting a ton of income, but we're ahead of schedule on all of that so far. And this is only showing 7 of our communities. So we don't start reporting on a community till it's had a full quarter of operation. So we had 2 communities that we purchased last quarter, Oak Hill in Lakeland, Florida, and then Westwood, a large community, 267 spaces in Greenville, North Carolina. And so we'll start reporting the financials on those, or including those in the next quarter report. And I should mention, as we turn it over to Luke, we're going to spend about the first 30 minutes kind of going through the material that we've prepared, and then we're going to open it up for questions and answers. We have Paul Anderson, one of the investors in Fund 4, that's going to be has kind of collected or aggregated a bunch of those questions, and we'll go through a Q&A session as well. And we're going to try to cut off right at 1 o'clock our time.
All righty. Well, first thing, a little correction here. My title is actually COO. Becky is the CFO. She'll be introduced later. So I've been working with Sam for the past couple of years, although I've been involved with Saratoga Group as an investor for, I think, over 10 years now. I previously worked in the oil industry for ExxonMobil. Long story short, now I'm here with Saratoga Group and having a lot of fun doing it. So a lot of my time is spent looking at and stewarding capital projects with Fletcher. And typically, some of our biggest investments are improvements to infrastructure, including roads, driveways, sewer and water, electrical pedestals, things like that. In addition, we love to build playgrounds in our communities. I don't think we've bought in a community to date that actually had an existing playground, even though we have a lot of children in our communities. So we love to do that. And signage, so down here in the lower left is a metal sign that just finished fabrication, and that'll be installed for our park in Marietta, not part of Fund 4, but that is the sort of sign that you'll be seeing installed at parks like Westwood and Los Robles. And that final product will look something similar to that Park Lane sign there. So great thing about OZ funds is we are incentivized to spend a lot of capital up front, so we can really improve these communities and make them better environments for families. And Fletcher, as I mentioned, is involved with a lot of those projects as well, particularly office remodels and solar lighting. And he's going to talk a little bit about solar lighting and some of the exciting things and cost savings around that.
Thanks, Luke. I'm Fletcher Alexander. I joined Saratoga Group this past January. Very excited to be on board here and being a part of this team. There's a lot of exciting stuff going on. So, as Luke mentioned, one of my primary focuses is capital projects. I'll mention quickly just a little of my background. I got my bachelor's and master's from California State University, Chico, and worked in Chico for a number of years as a city planner with the city of Chico and an administrator and program manager at CSU Chico as well. I've worked in the private sector for a few years in Sonoma before coming over to Auburn to join Saratoga Group. So again, very excited to be on board here. And so I wanted to highlight for you one of the projects we've been working on for the past few months. Street lighting is a need that exists in many of our communities, and we've gone through and audited most of them to look at the existing lighting levels and lighting infrastructure. And so in some of the communities, we're adding more lights. In others, we're replacing existing lights with solar street lights. And so I wanted to kind of walk you all through the process we've gone through. We started initially with this Gamasonic GS100 lighting fixture as our go-to option for installing new lighting in the parks. This is the figure on the left of the slide there, and that is typically mounted on a 10-foot pole. So that's the solution we were working with. So you can see in the chart across the bottom, I've got some of the different things we've been comparing across these options. And so that's about a 900 lumen light, and the full installation cost for the fixture and the pole and labor is just under $1,500. So it's relatively expensive and wasn't really providing the sort of lighting that we were looking for in our communities. Yeah. And Fletcher, yeah, if I could jump in real quick. So kind of a little more background on this is even previous to Fletcher coming on board as a project manager, this is something that we were pursuing for about a year, trying to figure out what is the best way to light up our parks, A lot of our communities, we're paying for electricity from the utility provider, and it'll run between $1,000 and $1,500 a month to light kind of the general overhead lights from the utility company. So we were looking for ways to save money as well as to increase the lighting at our communities.
Thank you, Sam.
Yeah.
Yeah, so a lot of factors to consider here, and we've kind of broken them all out there across the bottom. So we did some research into solar lighting technologies and found a great company, Tenku, that makes some really innovative solar lighting solutions. And we have installed, excuse me, 3 of them in one of our communities in Alabama, 3 different technology types, 2 lights of each. So one is the T-Series 30 watt, another is the T-Series Plus 50 watt, and those are the 2 options in the middle of the screen. And finally, we've just recently installed for trial the T-Series Pro 120 watt. And so you can see how these lights compare. The costs are significantly less than what we were looking at with the Gamasonic. The lumens significantly brighter. And in the 4th column there, we've broken that out as cost per lumen. And so we moved from about $1.60 with the GS100 to about 11 cents with the T-Series Pro 120 watt. So it's a huge difference. These lights are mounted on 18-foot poles, so they're significantly higher off the ground than the GS100. So they're lighting a larger area. They're much brighter. They actually come with a longer warranty. They're a more durable product. And, of course, they're solar, so they're not tied into the grid, and we don't have ongoing electrical costs for that lighting. So we have been trialing those 3 technologies at one of the communities in Alabama, and we are planning here soon to start to scale those out across a number of our communities. So we've been very happy with the results and happy to share that with you all.
Yeah. Awesome. Okay, Josh.
All right, thank you, Fletcher. I started with Saratoga Group about a year ago, the regional manager for the company currently. Before I worked at Saratoga Group, I was in property management, and before that, regional management for different retailers. What I'm going to talk about for just a minute is our digital marketing. And what we currently use is ShowMojo. It's a holistic platform that automates the leasing process for companies nationwide. The program, we use it, they syndicate it out, all of our listings, to showing sites such as Zillow, Trulia, Zumper, and Zumper actually feeds into Facebook Marketplace, Apartments.com, and Realtor.com. ShowMojo screens all of our prospective tenants by asking them different questions such as their move-in date, their income, and if they have any pets. It allows the prospective tenants to book directly on the listing site at a time that works for them to view the home based on what our showing agent has available on their calendar. The day of the showing, it actually confirms the showing with the prospective resident to make sure they're actually going to make the appointment and they did not forget it. And then once they actually view the home, it sends them a survey afterwards, and that survey asks them for their experience with the showing agent and what they thought of the unit they viewed. And up on the screen, we have a few of our results from ShowMojo. In Greenville, North Carolina, you can see we have Fairview and Westwood listed there. We had 2 different test ads that ran for approximately 2 weeks total. We ran 1 test ad for $700 a month, and it generated 53 total leads from ShowMojo. We ran another test ad for $950 per month, and it generated 16 leads. Based on the data we've received, the initial order of 15 brand new true homes is being placed for the Greenville market. Los Robles, which is in Rockdale, Texas, we've had 6 total lease options so far this year generated from Kirsty's ShowMojo listings. 6 total from January to March, and then 11 actually total this year. So quarter 2, she actually had a lot that already came on. Then with South Rogers in Bloomington, Indiana, we've had 2 different homes listed at $750 per month. They've already have a lease option on them. One of them has 36 leads, another one has 62 leads. So it just really shows that the Show Mojo is really working for us. It really produces the leads we need to generate the foot traffic into the community, and it is very inexpensive overall for us to use Show Mojo.
Yeah. Josh, a couple follow-up items there. So
Yep.
what would you say for us when we get a new client moving into our community, what percentage of the time are they coming to us through Facebook Marketplace?
Oh, I would say probably 75% of the time. In most communities, there's a few exceptions, but across our portfolio, 75% of our new residents are coming to us through Facebook Marketplace, and Facebook Marketplace is being, fed from Zumper, which comes from Show Mojo.
Yeah, and then out of the remaining 25%, obviously these are rough numbers, but what percentage of that is referrals from people that are already in the community?
The majority of what's left.
Yeah.
Especially in a few of our communities in particular, we have a lot of resident referrals. Los Robles in Texas, actually, Christy gets quite a few resident referrals, and just from having it's a smaller town and everyone knows, pretty much everyone there. So she gets a lot of customers just based on who she knows there in the city.
Yeah, awesome. So 2 points I kind of want to make with this. First of all is that, as Josh pointed out, Facebook Marketplace is really, in terms of the digital marketing, that's everything for us. So, before you would think of things like Craigslist or even Zillow pretty recently, but it's dominated for us by Facebook Marketplace. And so the key to the Show Mojo platform is that Josh, as a regional manager, or myself sitting here in the office in California, it auto syndicates from our property management database into Facebook Marketplace. If it didn't do that, it would be a difficult thing for us to stay on top of, hey, do we have active listings in each of our markets? What kind of response rates are we getting? Are they converting from interested into leads? Are they showing up for appointments? Basically, all these reports at the click of a button through Show Mojo, which again integrates directly into our property management system, we're able to get that information. So it's really been a huge asset for us. And the other thing is simply the ability, for example, during this crisis that we have, that we just are still kind of coming out of, when it was difficult to show homes, we had the ability, we were ready to do this. We didn't end up needing to do it, but to do kind of autonomous showings where through Show Mojo, you can have a virtual lock that's put on the door to the mobile home. It gets opened with a code for a prospective client that basically passes a background check and maybe a credit check, depending on what we want them to do. And so that was one of the reasons we were looking at it as well, is to have that ability in the future if we ever needed it. And of course, we had no idea that something like the COVID crisis was going to happen, but we're prepared for that if something like this happens again, that we can kind of have these autonomous showings and people can just show up and not even meet a manager. Okay, great. Thanks, Josh.
Great, thank you.
I kind of covered the financial stuff already, so Becky doesn't have to say too much, but wave at the camera. I'm just going to brag about Becky a little bit. She's been with us about a little over a year, and she has tremendous amount of experience, controller level and above, in terms of real estate in general, but specifically in the mobile home community industry. She's got a lot of experience there. She was with a large owner in the Sacramento area, Follett USA, and they have a very large portfolio. So she's really helped to kind of bring a lot of that experience to bear on our group and on our team. So appreciate that. At this point, I think we're going to go ahead and move into the questions. And let's see. Paul, I think you're on this call. Let me find you, and I'll unmute you so that you can ask some questions.
You guys hear me?
Oh, yeah, I can hear you. Perfect.
Awesome. All right. Thanks for inviting me to ask some questions. Thanks for having quarterly presentations, and appreciate all the hard work that is going on. So I've got 13 questions here that I've collected, and I see a couple in the chat. So I will just fire away here with the questions.
I'm having a hard time hearing you, Paul.
Is it any better if I hold the? Is this any better?
Yeah, that's better. That's great.
Okay.
Thank you.
Okay, so first question is there any news on the pipeline or potential deals, given I believe there's about $3 million in equity to work with in the fund? What is the game plan here?
Yeah, I'll address that question. So we do have some deals. Really two of them, maybe working on a third on the back burner. We're not pursuing any of these very aggressively at this point. Part of it is we feel like there may be opportunities here over the next 6 to 12 months to pick up communities at some pretty aggressive pricing. But let me just kind of speak to what we're looking at. One of them is it's actually it's 52 units, but it's actually a collection of duplexes directly next to the Westwood community that we bought, that we purchased in Greenville in Q1. And it's interesting to us simply because they basically share a common entrance, and the sort of amenities that we're looking to add to that community, we could basically amortize that cost over these duplexes that are there. It's a very motivated seller, and we're looking at a price of around $30,000 per door. So we think that may be a very interesting cash flow opportunity that we can kind of add to the portfolio. Other than that, of course, it's mobile home communities. We've got one that we're looking at. We have been looking at for a while in Kansas City. The pricing is, and I'm sorry, this is not the two that we dropped out of escrow on. This is a different community in Kansas City, and pricing we've seen that get more aggressive over the past few months, and it's a good park. It's a little over 100 spaces. A lot of work that needs to be done. I mean, it fits the OZ profile pretty well, but the pricing just didn't make sense to us at the time. But I think the seller's getting a little more reasonable, and so that'll be something that we're watching as well.
Awesome. Okay, so there's two questions around tiny homes. The first one, will any tiny homes defined as architecturally striking small homes as opposed to the typical boxy mobile homes be built or installed at Fund 4 locations? And then relatedly, I'd be interested in hearing an update on the plan for Vegas. Can you walk us through the high-level economics of the tiny home plan, why this is a good opportunity, and then a comment about Vegas being particularly hard hit with COVID, I guess, with hospitality and casinos and everything.
Yeah, there's a lot to unpack there. So let's first of all, Kate, maybe just address the tiny homes. Luke, I know you've been having a lot of those conversations with Clayton. Do you kind of want to provide an update on that end of it and kind of where we're looking to put those?
Yeah, so the primary communities where tiny homes would be a good fit is the two in Daytona Beach and in Silver City in Las Vegas. At this point, we're looking more at kind of middle of the road tiny homes, not the real high-end ones. So we're talking 40,000 plus range rather than 50, 60 and above. I could share my screen if you want to know more information about those. But anyway, Clayton has a plant in Waycross, Georgia, about 300 miles north of Daytona that would be, a good fit for distance and the type of homes they make. And later on down the line, I think as we continue to replace old homes with new homes, then it could make more sense to bring in more the higher end home as the market kind of fits the demand.
Yeah, and Luke, I'm happy to stop sharing here if you want to share that those floor plans or elevations.
Sure, yeah, I've got those websites open here.
Okay, so I just stopped sharing. While Luke's pulling that up, let me kind of mention that the tiny home movement is kind of interesting, and I'd say it's bifurcated at a minimum into a couple different categories. One of them being kind of, it's trendy and millennials and people kind of wanting to have a low footprint, low impact sort of living arrangement. And what I would say is that's not our business. I mean, our business is truly affordable housing. And so at the point, for example, in Daytona Beach, where we have small lots, it's a retirement community, and people don't need a lot of room, but they definitely need affordable housing. Then a tiny home, quote unquote, is a good fit. But we don't ever anticipate being in a space where we're just kind of going out, like Luke says, the $80,000 tiny home that you see on TV that looks super nice. That's not really our market. On a dollar per square foot basis, it doesn't make a ton of sense for us.
Yeah.
Okay, Luke.
Yeah, and that pretty much. I'm showing two websites here. So this one is the Clayton Waycross website, and they make this 16-foot by 36-foot home. Again, it would be in the $40,000 range, maybe $45,000 once we get it all installed with skirting and things like that. Versus going to, and this is actually a Clayton home as well, Lakeside. Now these aren't, again, the high end tiny homes, but we're talking $50,000, $60,000 homes. This is one that we kind of like here, the Sedona. And maybe a few years down the line, as we, again, replace some of these older homes, something like this type of home could make sense in a place like Daytona or Silver City in Las Vegas.
Awesome.
Yep.
Okay.
Sorry.
I'm still seeing some
And Paul.
Oh, go ahead.
Oh yeah, I was going to say there was another part of your question, right? Which is kind of, do you want me to address that now regarding Vegas and the plan there and our thoughts?
Yeah, that'd be great.
Okay, so Vegas, that park is interesting. I mean, I'll say a couple things. First of all, it's a total of about 5.5 acres. The current mobile home community with 53 sites occupies less than half of the park, or less than half of the land, and it's actually zoned for 150 units altogether. I mean, that's the zoning that it has currently. We wouldn't have to get it rezoned or anything like that. And so, knowing that, I mean, that all along, when we at purchase, we had the thought that, let's see, this may be something we could pursue and try to obviously increase our density, increase our unit count substantially. So let me kind of just run through the rough numbers on that. We're working with a contractor there in Vegas who we basically met him because as we were visiting other communities that are doing similar things, or expanding or kind of redeveloping mobile home communities, twice from different independent people, we had the recommendation of this contractor who was doing the work there. And so he's kind of penciled it out, and we're probably in the $15,000 to $20,000 per lot development costs on doing a development like this. Of course, we then have our cost of it cost us $2 million to buy the community. But then basically, if we go to 100, we're looking at doing a development of 150 units there. Even if we kept the rent the same as it is now, $450 a month, those spaces would be worth over $60,000 each. Just in terms of, if we took the income it could generate over a 7 cap, it's over $60,000. If we get the rent up from there, which we should be able to, right? Because we now have a brand new community, really nice streets, really nice roads, great infrastructure. We have 2 communities very close to us where the rents are at $650 a month. And so if we, at $650 a month, the value on a per lot basis is over $90,000. And so you can see that it's a pretty compelling opportunity. And we'd approach it in a sense. It's almost like starting over, but we're gonna phase it a little bit so that we can keep revenue going while we do the development. So hopefully that addresses that question. Got it.
That's great. Can everyone hear me okay? There's still some comments in the chat saying my audio is not great. Are you able to hear me okay?
I can hear you great, Paul.
Okay. Awesome. Okay, so the next question is, it's around potentially a new fund. And the gist of it saying, I really like Sam and the team, been very impressed thus far, but essentially curious how they can keep their eye on the ball of Fund 4 while doing all the work that entails with COVID, with the QOZ regs, with deploying capital, and also thinking about finding additional properties with fundraising and additional diligence on a future fund.
Yeah. No, it's a fair question. So first of all, I should say that on Fund 4, and I know this was another question that we saw, I think, in the initial batch that came over. We're at about $12.5 million. Fundraising slowed way down on this Opportunity Zone Fund, kind of after the end of the year, and then with the COVID, some people pulled out. Anyway, but either way, we're going to cut off the fundraising June 30th. So we think we'll actually probably fill it up, if not get very close to having it full by June 30th. But either way, we're going to close out the fundraising for Fund 4 on June 30th. So that's part of it. The other thing is, we're, part of the goal here was to have a lot of our key members on this call. I know I talk to people a lot and they say, well, Sam, Saratoga Group is you, right? Like, well, oh yeah, and then your brother, and it's like, no, we've got a team here. In fact, I could probably pull up the org chart real quick. Let's see. Give me a second here. Are you guys seeing? You're seeing the presentation still?
Now I'm seeing a website.
Yeah, perfect. Okay. So I gotta kind of hide this. There we go. And move it. Perfect. Okay, this is our wiki site, but on our wiki, here's our org chart. We use Google tools, G Suite, and what's nice is everything's dynamic. So actually, this org chart, as we add people to the organization and who they're reporting to, it automatically repopulates every time we pull it up here. So you've got myself and Becky and Fletcher. We're all located here in California. Luke in Nashville, Tennessee, our COO. And Josh is our main regional manager. Under Josh, these are our on-site managers. One thing that I would mention here in response to this question is we hire people that are, I would say, overqualified in general for this position. I could highlight Aaron Gutierrez here. Aaron has both a bachelor's and a master's degree. That's definitely atypical even for us as an on-site manager. But every time we hire an on-site, we're looking for somebody that can grow in the company to become, for example, the next regional manager, which Aaron has done some fantastic kind of tech work for us, as well as a lot of the marketing that he's done. He's just doing a great job in his communities. And he's going to be one of these people that's definitely going to be a regional for us in the near future. Over on the accounting side, so we have Becky, and then we've got 4 others in our accounting group. Sharon recently joined us just a few weeks ago. She's our assistant controller. And then Teresa is also in accounting. She's got a bachelor's degree in accounting, Debbie in accounting, and Patty as well. So we're building a pretty good team. We're actually in the middle of hiring for a couple more positions, one of them being an analyst position that we'll probably have them hired here in the next few weeks. So I mean, I'd say that's the biggest part in terms of, how can we kind of handle and manage all of this is we put processes in place, and then we hire bright people that can help us kind of execute on our business plan. And that's really a key to it.
That's great. Okay, next question. Just looking to get comfort that the fund is in compliance with all QOZ regs and guidelines so it maintains its tax advantage status.
Okay, I'm going to turn it over to Becky for this question.
So the OZ regs seem to be constantly changing, so we're not always the expert, but we have engaged experts in the field, and we rely on their advice, and we follow it to a T to make sure that our investors are clearly the important issue here and their funds. So we do the twice-a-year testing. Everything is going as it should, and as things evolve with the regs, we will change or add whatever we need to do that. But we are constantly watching that with our consultants and making sure that we do comply and that we save the tax benefits for everyone.
Yeah.
An overview.
Yeah, awesome. And I guess the only thing I'll add to that is just, for example, we've got idle cash in the fund right now, right? Because we had those properties we were planning to purchase, we pulled out. The nice thing is we have a very cash efficient fund. And what I mean by that is we have, for example, we've got a pretty aggressive plan to bring in brand new homes to these communities. Well, we've got a financing arrangement set up with 21st Mortgage that allows us to bring in millions of dollars worth of homes with, us paying typically $3,000 kind of on a per home basis just for setup, skirting, sometimes the move. So it might be $3,000 to $5,000. So the point being, getting a ton of leverage there. However, now that we're in this situation where we're kind of pumping the brakes on acquisitions while we really try to find where the market is and to try to get some, really favorable deals for the fund, we're starting to now use cash for buying these homes and saving on the financing expense of those homes. So that's kind of the nice thing is that we're still able to meet the OZ regulation and yet be efficient with the cash and not just have it sitting in the bank account for 2 years.
Another finance-related question: did Fund 4 receive any PPP funds?
No, we did not. The fund did not.
No. And the other, part of the point on that is it looks at 2019 payroll and well, anyway, obviously we had some payroll expenses in 2019, but not very many.
Next question, can you walk us through the current NOI and your planned expectations for this to increase to a level high enough to pay out the preferred returns?
Yes, let's see. Okay, you know, I think for this, I'm going to go ahead and pull up, let's see here. I'm going to pull up our rent manager system. So this is our system that we use for, you know, managing all the properties. And I don't know if you can see this very well, but I'm going to go ahead and run in real time a profit and loss. And what I'll do is...
We can't see your screen, Sam. Not the rent manager screen.
You can't see it. Okay, hold on. Thank you. Let me try this again. I'm used to using Google Meet, and it kind of swaps around whenever you change screens.
Yep,
But
we can see it now.
you should be able to see it now. Yeah? Okay, awesome. So to answer that question, okay, here we are in Rent Manager. I'm going to go to Fund 4, and we're going to run a P&L for the month of April. And we haven't kind of gone through and capitalized what needs to be capitalized or any of that necessarily at this point. So I'm just going to kind of focus on the income line. But you can see our gross income for last month of April, is about $150,000. Let's, again, we're using round numbers here, right? But let's use a 50% expense ratio, which over time we're going to do a lot better than that. But initially, the expense ratios do end up being higher as we're kind of, you know, renovating homes and doing these things to these communities. So that'd be about $75,000 in NOI a month, and with 12 million in equity, right, up through the end of April. I'm sorry, the end of March. That's a yield of about 7.5%. So I just kind of want, that's kind of the round numbers of regarding, you know, how are we doing with regards to generating enough net income to kind of pay the pref, even though we're not paying it out yet. That gives you an idea that we're, you know, we're kind of right at that number. And of course, that's unlevered, right? So on a cash basis, it's actually going to be higher than that.
And then there's a related question. When does Fund 4 anticipate paying returns to investors?
Yeah, so our initial plan was that we would start paying those Q1 of 2021, and that is still that's still the plan. That's very much the plan.
All right. Has there been any change in your financials? I think this is your personal financials that would compel you or Luke, you being Sam, to invest in Fund 4?
Yeah. So yeah, I do not have capital gains to roll into the fund, and you know, of course Luke and I talked about this question, and he doesn't at this point either. So nothing has changed there.
Okay. Does each mobile home park have a paid on-site manager? And if not, how often are the parks visited by someone from Saratoga?
Josh, you want to address this question?
Sure. Actually, as a general rule, each park does have its own on-site manager. There are a few exceptions, and one of them is South Rogers in Bloomington, Indiana. We have a great manager in Illinois, and she manages some communities for us in our Illinois market. And she also manages the park in South Rogers, making regular visits. But in addition to her, we have a resident who lives in South Rogers who does home showings for us and takes weekly videos. But I think every other community in Fund 4 has an on-site. Sometimes that on-site will manage more than one community at a time if they're in the same city. But every park does actually have an on-site manager.
Our next question is, what can Fund 4 do to increase community building efforts in mobile home parks, especially to attract residents to a park who might otherwise not have considered living in a mobile home park?
This is Fletcher, so I'll speak to this one. There are really a lot of different things we're doing to build community in our communities, and I want to kind of focus in on a couple. Can we pull up the Facebook page?
Yeah. Let's see here.
So I guess a piece of this was touched on with the capital projects. Obviously working a lot on putting in family amenities in the parks, which goes a long way. We've been doing a lot in the digital space, and in particular, we've put a lot of effort into building out our Facebook communities.
So let me.
So we've, Saratoga Group Communities has a Facebook page. We certainly hope you are all following it, and if you're not, this is a great opportunity to hop on Facebook and do so.
Can everybody see the Facebook page now?
I can see it.
Yep.
Great.
Okay. So this is our main page for SG Communities. I guess I'll show real quick. We have a group page set up for all of our communities. So that's something we set up right away as soon as a community becomes a part of our portfolio. So just showing all those there. Those are essentially individually managed by the on-site managers. We provide some administrative support from the office here. But basically, we create these group pages and hand them off to them. And these groups are intentionally set up to be public.
Why don't you show Westwood?
Okay. So
There it is.
thank you. All right, Westwood is a good example. Growing the membership takes some time. We certainly, proactively reach out to residents and encourage them to join, and do some other promotional work to grow the membership. Our on-sites post essentially once a week is the standard we're trying to get to across all of these groups. General posts about the community, things that are going on, positive aspects of the community, work that's being done to improve it, stories about residents. We like to highlight folks moving in, and, general things about the region. So you can see there's quite a bit of activity on this page. There's a great post. So is this the one with Shanika?
No, that's on, that's Genesis.
Genesis, okay, yeah. One post in particular. We've really been emphasizing move-ins lately, and so capturing good pictures of residents in front of their new homes. Here we go. So this was one of the earlier ones. This is Shanika Taylor, who had just purchased a home in the community. And there was actually a great story behind that and the work that our on-site manager, Jackie, did with Shanika to help her get in home. Excuse us there. So anyway, great story behind it. Here she is, very happy moving into her new home, and it's a great Facebook post that got a good bit of activity and actually ended up getting reposted by someone in the community with a lot of followers and had a lot of comments and activity there. So these are the types of, posts, types of content we're looking at building into these groups. We then share a lot of this content across the SG Communities page. So that's a great place. If you're following that page, you'll see many of those posts shared from across our communities. So Facebook is a really important platform for us for community building. It was touched on earlier with the marketing. It's one of the main ways that residents are finding us, and it's one of the better ways for us to communicate with our residents and foster community building. So this has been a big part of our efforts. I'll also mention that we're working towards establishing sort of peer volunteer outreach type of groups, and in particular in one of the parks in Florida, we've had sort of a community watch group that's been established under the leadership of our on-site manager there. And that's been very well received by the residents. And so, yep, these are just some of the efforts we're working on there.
Yeah, I can see some of you liking or following SG Communities right now on Facebook. Really appreciate that. Yeah, if you do that, you'll see a lot of updates coming through. It's like we mentioned, almost all of our online advertising that brings residents in is through Facebook. So we really are very focused on this platform, and we find that it really does help to foster community, and people start sharing information. We try to not only give updates here, but share things that are helpful for the residents. For example, we shared across all of our groups information about how to get a stimulus check, especially if, just different situations, and just trying to help people out during the difficult time that we're having right now.
Sam, could I mention a couple things real quick?
Yeah.
Yeah, and just kind of further to what's been said. We try and convert all of the homes in our park into tenant-owned homes, and that's a big part of community building as well. Rather than essentially like an apartment complex, people are coming and going, and just as renters, when they own their home, they're invested in the community, they build their gardens, they take pride in the community. And I think when other people from the outside see that, they realize, okay, this is a community, not a trailer park. And we definitely try and make that distinction. I think one area where we have kind of an edge is the ability to attract the Hispanic demographic. And for example, in Greenville, our assistant manager is bilingual, and a lot of our residents are Hispanic, and a lot of our potential residents are Hispanic. So we definitely tried to make sure we can speak their language, understand what they want for the community, and cater to those needs. As an example, for example, Los Robles in Texas, we will be building a large soccer field there, which we find is something that Hispanics in particular appreciate and will use, and will be a draw for their community.
Yeah, Luke, thanks for bringing that up. So, and I know we're getting close to ending here, but I just wanted to say one more thing about this. Data is very important to our company. So there's not a ton of data on the mobile home park industry, but I've shared this possibly in some posts or other information some of you have seen. There's a professor out of Duke University who's done some interesting studies on mobile home communities, and I've actually had the chance to meet with them in person, and we've talked about some things. But one of the interesting, I guess, nuggets that he extracted in his research was he found that there's basically zero correlation between the amenities in a community and the lot rent that's charged. And so sometimes you could look at data like that and you're like, well, maybe we shouldn't add any amenities. Like, why are we doing that? And despite that data, like I said, we're always paying attention to the data, and that's important to us. What we do know is that if we build these amenities like the playground, like the barbecue area, like a soccer field, these things don't cost a ton of money. What you have is you really, like Luke said, it's no longer a trailer park. It is a community, and it's economically going to be the best thing as well. Because what happens, and this doesn't always show up in the data, but what we're after is we're after a sticky tenant base. We want people to buy a home, they move in, and it becomes an appreciating asset. What I mean by that is, if we're adding amenities and we're creating a community where people feel safe and there's good lighting and the roads are in great shape, they never want to leave. And if they do, there's going to be 10 people waiting in line to buy their home and come in and replace them. So So anyway, that's really our business model. It's a longer model. It's perfect for a long-term fund like Fund 4 and all of our funds, and we're seeing it play out on our earlier funds. We build this base, and people just don't go anywhere, and they start telling their friends, and it's an awesome thing to see.
Okay, we got 5 minutes, and we have 5 questions between the list and the chats. We'll go for a minute of the question here, if that's possible. I think you answered part of this already, but how much more capital do you anticipate raising for Fund 4, and when do you think you'll close new LPs? I think you said June 30th.
Yeah, so we're going to close June 30th. At a minimum, we'll get another $1 million based on some very active conversations, and I believe we'll probably close at or close to the full $15 million.
What is the financing or debt market like for Saratoga at present, and with the current $3 million in equity, how much financing would you be looking for?
Yeah, this is probably the biggest disruption to the business, is the financing. And it's actually just in the past week, things have really started to thaw on that front. And what we're seeing, especially in, because a lot of these the kind of communities we're buying in this fund, the exception would have been those 2 in Ottawa, Kansas, where we had some Fannie financing lined up, but most of them aren't going to qualify for that. And so it's a combination of seller financing, right, that we've seen on a couple of communities, or it's kind of the smaller or regional bank type of financing. And so those lenders are now pretty active. And so we really don't anticipate having trouble with the financing, and it should look similar, kind of 65–70% on the front end in terms of the financing that we'd have. And then with, our allocation to the CapEx budget, we're really, across the fund, we're at a little less than 50% leverage is where we're kind of landing, and that'll continue to be the case.
We've got a couple from the chat. I think this pertains to something you said early on. If you account only for lot rents, how does revenue and NOI compare to projections?
Right. So that'd just be looking at recurring revenue. I'm not really prepared at this point. I'll have to follow up on that because we didn't break down the revenue. You know what? Maybe what I will do, though, we actually just did this analysis on some of our other funds, and let me pull that up really quickly because I think it answers the question, even though I don't have that information ready for Fund 4. Let's see. I need to stop this sharing, and let me do a new share of this. Okay. You should see an Excel sheet now. Do you guys see that?
Yep, see it.
Okay, awesome. So I don't really want to focus on the numbers. This isn't even the same fund, right? But I want to focus on kind of the trend that we typically see here and that we're seeing in Fund 4 as well. So this is actually Fund 1, and we're kind of picking up here in Q3 2018. But you can see, so the dashed line, that's the projection. The blue bars, and this is the gross revenue. The blue bars are the the actuals that we saw on a quarterly basis. And this is what we often see is we'll see the gross drop over 3 quarters or something like that, or maybe in this case 4 quarters, and that's a reflection of we're kind of converting. So we're generating non-recurring revenue as we're turning homes and that sort of thing. But the NOI kind of bumps along, and then as you can see here, starting Q3 2019, Q4 is maybe just up a bit, but then last quarter, and then things start to really take off in terms of our expense ratio goes down because now we've got stabilized recurring revenue. And that was the main reason why on Fund 4 you know, we didn't want to start paying out in the first year because we wanted to make sure that when we're paying out, it's based on recurring revenue, not these one-time sales and that sort of thing. But anyway, this is just kind of an example from Fund 1.
Okay, we got two more if you want to, if we can go just a minute or two long.
Yeah, why don't we get these last two, then we can
Okay.
close.
For Show Mojo, what's the conversion rate from leads to actual lease signings?
Good question. Josh, I know you've looked at that data.
I have.
Do you have a good
It
answer?
really depends. I don't have a great answer. I apologize. The best answer I can give you is it really depends on the market. In Bloomington, Indiana, it's been a pretty high percentage. At one point, it would take about 10 leads before we get a transaction out of it. In North Carolina, it's really hard to tell because we really didn't have available inventory. So we ran the test ads to see what response we would receive. And we received a great response, but they were just ads that we put out there to test the market. So until we actually get the inventory in those communities, it's going to be hard to tell in the Greenville market.
And Josh, maybe another way to answer that question quickly. I mean, I can understand the intent is, hey, how hard is it to fill these communities up? Are there any of our communities right now where we've got inventory in Fund 4 that's sitting, waiting for somebody to fill it? Or
No.
are we filling them? We're
No.
basically filling them as soon as they're
We
ready.
are. And with COVID, we kind of expected to see a decline in appointments and showings and lease options. And if anything, we've seen the opposite. In March and April, March was our best month for lease options, and April was our second best month we've had. So it really hasn't hurt us at all at this point.
All right, and last question. Before going on a buying spree, what's the trend in unemployment rates, jobless claims in those cities and parks you're looking in?
Okay, so yeah, we're like I said, yeah, we're not going on a buying spree now, right? We're definitely waiting. What I would say in general though is the markets that we like the most, right? So if we look at Fund 4, certainly the market that we like least right now is Vegas, right? I mean, Vegas has tremendous demand for affordable housing, but it's obviously so impacted from the virus. And so, we wouldn't be looking, for example, to buy another park in Vegas. Greenville, North Carolina, where you've got a major university there, you've got quite a bit of technology manufacturing. It's really not any sort of hospitality. Nearly all of our residents are kind of in the trades or in manufacturing. That's a great market. Like we would, and we already own 5 communities there. If we could find 3 or 4 more in that market, we've got a great team in place. That would be ideal for us. But Bloomington, Indiana, again, a Division I Indiana University just up the road. That's been a fantastic market, tons of demand for us. We're seeing it in Texas as well. Texas hasn't been that impacted. And so yeah, I mean, we're definitely paying attention to, hey, what does the future look like under the virus, and where are the places we want to be?
All right, that's all the questions. So from my side, thanks a lot, Sam and team. It's awesome to see the whole team and hear from everybody. So I appreciate it. I'm sure all the other LPs do as well.
Awesome. Yeah. Hey, we really appreciate everybody joining us today.